You've probably heard of mutual funds. Even if you haven't, but you have a 401k or other employer-sponsored investment account, odds are you own one. In fact, an estimated 100 million Americans own a mutual fund as of 2017. People use them to save for retirement, college, or buying a house. The mutual fund industry in the US alone tops out at around $18.7 trillion. Here are the basics behind mutual funds. A mutual fund collects money from a pool of investors and buys stocks, bonds, or other securities. Many traditional mutual funds are also actively managed. That means there's a real live human being who makes investment decisions for the fund. Most funds have specific objectives, like limiting risk in the short term or maximizing long-term returns. And active managers need to make the right decisions in order to meet those goals. For example, a mutual fund in your 401k might be designed to help people retire by a certain date. Those are called target date funds, and they're most often the default plans in your company's 401k. In those funds, the portfolio might stick to mostly stocks early on, since investors can afford to be more risky when they don't need quick access to their money. And when investors come closer to their retirement age, the funds shift toward a more conservative approach, oftentimes moving the portfolio more toward bonds or other less risky investments. Some mutual funds also follow specific stock market averages or sectors, similar to exchange-traded funds. That all sounds nice, but investors should watch out for one major drawback with mutual funds: fees. In exchange for having a professional actively making investment decisions, mutual funds charge fees that come straight out of the giant pool of money. Even fees that look small on paper, like 1 or 2%, can eat into your returns over time. If the US enters a recession or stocks barely move at all year to year, a few percentage points can mean the difference between losing or making money. So when choosing mutual funds, be sure to check out your risk tolerance and any fees it carries before making a decision.
Invest in you. Ready, set, grow. CNBC and Acorns.